On today's show, 3 questions. Number 1, how did the U.S. stock market receive the Fed news? Number 2, is the world actually worse off today? And number 3, does having a brush with death increase your likelihood for saving for retirement? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Victoria.
And I'm Rabih.
Dream team, here we are.
We're so good at those intros now, you guys. We got it on lockdown.
We've got it on lock. It's really
I know
good.
it's the same order every single time, but I really think it gets better.
It does. There's no hesitation on that one. Guys, it's fun to be back. We have 3 of the 4 from last week. It's always fun to kind of keep the momentum going from the same group.
Yeah, Will didn't make the cut.
Will could not make the cut today. I think he's busy changing clients' lives. Let's jump right in. Rabih, how did the U.S. stock market react or receive the Fed news?
Yes, so I was preparing this topic last night, and this morning I wake up checking the financial news as I usually do, and there was an article titled, "The S&P 500 just had the best first quarter since 2000, which I was like, oh, okay, I'm a couple of hours ahead of the news because I thought of this first.
I should be a writer. I should be a journalist. Yeah,
I'm going to work for like Bloomberg or something.
Yeah.
Anyhow.
No, you're going to stay right here.
Yeah, you're not going anywhere. You're not going anywhere.
Don't say that.
I thought that would go under the radar. Anyhow, Bloomberg, if you're listening. I know they're
like,
fans
Bloomberg,
of
save me. Bloomberg, save me.
Help.
I'm trapped, Bloomberg.
Oh, God.
Blink twice, Rabih, if you feel like you're
yeah. We're already off the rails.
Anyhow, so it is almost the end of the quarter. This is actually the last episode in this quarter. And I was like, let's look at the performance of the market. And well enough, the S&P 500 has returned around 10% for the quarter. In one quarter, 10%. Russell 3000, which includes all the US market, not just the large cap, is around like 8. And then you got small caps, which kind of were the underperformers at 6. But it's still good, 6% in one quarter, right?
Yeah.
Those are really great numbers. And I'm like, yeah, well, the market has all the reasons to be happy because the Federal Reserve last week decided to gift us with a new summary of economic projections that showed that they now expect that the economy in 2020 is going to be growing at 2% on an annual basis, which is on their target, a little bit above it, and does not even come close to what a soft landing definition means, because soft landing means below average growth, and this is average growth, which is great. So what I wanted to do was like, okay, how much of this 10 actually is because of fundamental news, and how much of it is because, NVIDIA is doing great and we love AI and we're just riding the wave, right? And to give you the answer up front, it was kind of 50-50, which is, I would guess, is a really good sign. But here's the framework, and here's how we think about it. So on the long run, the returns of the stock market should be determined by 2 main factors. The first one is the real growth of the GDP, and the second one is the real growth of earnings, because the GDP can grow without the money going to the companies. And this is usually what happens in non-capitalist economies. It doesn't really have to go to the companies. So in our sense, let's look at what the Fed is saying about GDP. Let's look at earnings, and the difference is going to be the third component, which only works in the short run. And that third component is the change in the multiple, which is expectations on top of it. So actually the framework, the model that they use is changes in stock prices are a function of changes in GDP, changes in earnings, and changes in the multiple. Like, this is the technical part of it. So let's look at each of these components together, starting with the GDP. So the Federal Reserve said that they expect GDP to be at 2 for the whole year. Let's look at Q1 in specific. And the Atlanta Fed has this tool that we've mentioned before on this podcast called the GDP Now, which kind of is an impressive algorithm, kind of tells you in day-to-day real time what they think the GDP growth rate for Q1 is going to be. And on annualized basis, it is at 2, which is target. That's the first, I would say, kind of, they're not the same unit, like the 2 is annualized and the 10% return happened over a quarter, so they're not the same unit. But out of that 10%, there's a 2% that came from the GDP. This is how you can think of it. The second component is earnings. So earning growth projections for Q1, while they started stronger at the beginning of year at 5 annualized, actually quarter over quarter growth, they are now at around 3. So we've gotten 2% coming from GDP, we've got 3 coming from earnings out of the 10% return that the market reflected. This just tells us that probably the remaining half should be coming from a multiple change. And a multiple change is measured by the PE ratio. And the PE ratio is price over earnings, which reflects the investors' confidence or the multiple they are willing to price on top of the earnings to think that to get to a stock price that they feel is an equilibrium. And while we are in definite bull market categories, we started the year with a multiple of 19, which is, in historical perspective, a long long-term average is around 16. Anything above that bull market, anything below that bear market, we are already in 19. It went up from 19 at the beginning of the year to 20 now. And that is a really good, significant multiple change that would reflect that much in the market. And this is the part of the growth that is due to AI and due to NVIDIA and the momentum that we are seeing. So after this, analysis, thanks for joining me on this detour.
Thank you for joining Rabih's segment.
Thanks for joining me on this detour. Like, if someone tells me, oh, the economy is so good, and yes, this is why the market has done so great, I'd say, yeah, you are correct, up to 50% of the story. And if someone says, oh, the market is overvalued and it's just an AI hype and just wait until the economy slows down, I'll be like, you may be correct, but only up to 50% because there is a fundamental story to it, which is, just the market being uncertain and robust at the same time. So we'll see how this develops. And I'm hoping in the next few episodes, we'll actually do that same analysis for the other parts of a globally diversified portfolio, which are emerging and developed markets.
So a couple of things, Rabih. When people talk about the market being overpriced, we've talked about this before, but they're referring to that PE ratio, right? So historically speaking, if we're just referencing, you said historically it's about a 16 on average, or is the average. So I guess if we're just looking objectively based on that measuring, just that one specific measuring stick, you could argue the market is overpriced right now. What would you say to that if someone said that?
It's a slightly above average. And the reason it's not, we would say, oh, it's overpriced, it's at levels it's never been before, is because we've had episodes, whether it was right before COVID, right before the dot-com bubble, etc., where in terms of the price to earnings multiplier, it reached out to 23, 24. And just the movement from 19 to 20, it reflects a lot. I'm not going to give you like a specific percent return that will hit the market, but jumping from a 20 to 23 is even a bigger multiple. We might be talking about another 10, 15% onto the stock price before we got to that level. So for people who would want to say, oh, this is for people who use PE ratios and those valuation metrics as a timing tool to say, oh, this is where they are over, like it is overvalued, it's time to go out, they might be still missing. They might leave on the table 15 to 20% returns simply because it's not a one-to-one movement between the multiple and the stock market return.
And by the way, if you're a long-term investor and not a trader, two very different things, none of this should matter anyway. Yeah. You've got a long-term time horizon. So again, helping you navigate it all. The other thing, and this bleeds into kind of the second topic we're going to get into, and tell me if you guys disagree with this, but it does feel like and has felt like for quite a while that there's a huge like misalignment between the narrative and what's actually happening in the economy. Like I have, and I will go off of just like what I see in news, not that I'm like diving into the news a lot and I'm not on social media, but like even talking to people like friends, family, whatever, it has felt like for a long time, there's been such a misalignment between the facts of like what's actually happening in the economy and how people feel about the economy. I guess two-part question to you guys to have us discuss this for a second. Do you agree with that with that assessment, that you feel the same thing? And number two, what do you think is the reason for that?
I'll go. I mean, the negative headlines sell. Like, there's a lot of studies behind that, and that's a lot more enticing to see over like, hey, everything's great, you guys. Like, you'll never see a headline like that. Media wants to grab your attention, and so does social media, and fear is a really great way to do that. So I think, yeah, for sure, it's a bias towards negative news, if anything.
Yeah, I think that's a huge part of it. There's this whole idea of pessimism sounds more sophisticated than optimism. It's like I think we just are wired more for negativity. And pessimism sounds, I think Morgan Housel has that quote of like, pessimism sounds like you're trying to help someone, or optimism sounds like you're out of touch.
Yeah.
I paraphrase that, but I think there is an element to that. Rabih, what are your thoughts on that?
Actually, the first observation I would make is I feel like a couple of months ago, especially on this podcast, I think the difference between reality and expectations, the gap was much wider than it is today.
It's narrowing now. Yeah.
It is narrowing. And I think because reality is how the economy is doing, and expectations in a sense like how the stock market is behaving. And while the economy was like showing robust growth and supply is easing and inflation is trending downwards and the necessary slowdown is showing up in the economy, the stock market was crashing down. And because they think, oh, the Fed is going to overshoot, they're going to put us in a recession, and they were amplifying consequences that might be happening under a certain possibility. So now that, those expectations haven't been realizing, the market kind of took a breath in and, I don't know, addressed this more rationally and looked at the data. And that's why the gap has been narrowing. And in a sense, usually there's uncertainty, and the economic data is telling you something, and the stock market sentiment is telling you something. And at the end of the day, one of them will have to win. right? And one will converge to the other. We always say that the stock market is like 6 months ahead and they're looking ahead, but sometimes they do not look ahead in the right direction. And this is what happened in this last episode. They were looking ahead towards the recession, but that was not the right direction where they were looking. And the market kind of reverted back. We just had a 10% quarter. We ended last year with really good returns. So looking back is how we predict our survivals as a rates, and how the market is just an extension of that. And yeah, I think it's perfectly natural that sometimes expectations and reality will diverge. And as long as they converge back and like reset every once in a while, it's fine.
Yeah, and you bring up a good point, Rabih. I mean, there's kind of three factors. I presented two variables, but you're presenting a third, which you kind of approach that from the standpoint of like the market being misaligned with the economy or vice versa, which we've talked a lot about. And then there's the third variable that I threw out there, which is like just the general feeling, just the general vibe of like the narrative, the things like, again, to Victoria's point, the articles you're seeing, or just you talk to people. I also think the other aspect here, in particular this year, that this might get even worse, or who knows, and we're not going to go into this too far as after you hear what I'm going to say. But I do think an election year and the political divide in America plays a huge role in this, where one side wants a certain narrative, the other side wants another narrative. And again, we're not going to get political here, but I do think that'll. Let's do it. We said this last week. Why don't we just lean into it? Let's talk religion and politics. That's what we're going to start doing. But I do think that, But I do think that plays a factor as well, and probably will only get worse as the summer comes and we get closer to that election. I think there's a high likelihood of a lot of narratives misaligning with reality based on one side or the other.
Yeah, I found a quick stat for you based on this conversation.
Of course you did, study buddy. Hit us.
Forbes article. Let's see. Nature Human Behavior platform ran this study that found that negative news headlines drive more engagement than positive headlines, and each additional negative word in a headline increased clicks by 2. So the more negative words you have in a headline, the more likely people are going to read it. So
dang.
Yeah.
Yeah, I mean, we don't need to go too much more into this, but there's no question if you just look, I mean, this is just a fact. You look historically what news used to be 50, 60 years ago versus what news is today. You know, you look at what these news outlets found is that they were far more profitable when they could create more tribalism and like almost like fans of a narrative. And they kind of started to separate taking sides. And they realized that it was far easier to keep people engaged than it was to like the Walter Cronkite version of just like giving the actual news. Like those days no longer really exist. So
yeah.
Any other, Rabih, you look like you got a smirk. You got some thoughts.
No, I think we should change the podcast tagline of like helping dentists navigate all the noise to helping dentists navigate all the noise, catastrophes, market crashes, and end of civilization. And then we'll get more views. Yeah, like, it works.
Let's just keep adding a negative word each week.
Well, it's funny. We changed Victoria's. We're going to get this when we hit Victoria's question. We'll talk about that very thing while we change the word. We're playing into this as well. We're part of the problem. We're part of the problem. We are the problem.
It's the incentive. If people,
it is.
We give the people what they want.
We are just giving them what they want. It's so true.
Yeah, just.
Okay. Any other thoughts on that at all? Rabih, Victoria, any other?
No, I'm excited to get into your topic.
Number 2. All right. Is the world actually worse off today? I wanted to bring this back from last week. Actually, surprisingly so, we got no angry emails or phone calls or anything.
So we're doubling down?
We're going to double down. We're going to keep talking about this until someone sends us an angry email. No, I think one of two things could be true. We didn't get an angry email. So that means one of two things. Either A, people weren't angry about it, or B, they were so angry. They couldn't even email. They were so mad. Okay, I'm going to start this off with first. It's so interesting. Ever since that episode last week, we've talked about this a lot. It's actually been really cool. I think it's actually been really, really cool. We've been talking about this a lot, and like it's been in just within the office and within our team. It's been in really engaging conversations around this. But I'm going to start with this. I'm going to soften my approach here. I don't change my opinion. Or I shouldn't say I don't. I'm not changing my opinion on this. I still have my opinion. However, there's going to be no name calling here. I'm calling no one soft and no one entitled, right? That was unfair. That was being a bit, what's the word? Sensationalistic, or where you're just saying we're trying to get people riled up. But what I wanted,
riled up.
I got you riled up. Exactly. So I truly take that. I really do. I'm not going to generalize a population of saying like you're soft or entitled. However, I will stick with the fact that, and we're going to jump into this, that the gap, the real issue here of what we were talking about last week, the real issue is that the one thing that's grown more than any of these measures of like quality of life is expectations. And that's been the problem. That is my theory on this, or thesis, or whatever you want to call it. that is my current thesis, and I stick by that. And I wanted to bring some more data to this, but before I do, any follow-up thoughts from last week, or just as we jump into this, anything you guys want to say? No? Victoria, I know you got something.
No, I mean, it's just a little disarming when you get called soft on a dental-specific financial planning podcast. You know,
It's
the number
disarming
one.
or it's alarming? It's
disarming.
Okay, okay.
But then once I stepped into more of my study buddy brain and we had this discussion, you know, all of this past week, it's actually very fascinating stuff. So I think you should just dig into it and share with the world what we have found.
Let's do it. Rabih, any thoughts? You want to jump in? Okay. So I guess for those of you that didn't listen last week, we'll give you a quick context. Will brought an article from the Wall Street Journal that came out last week that said that I think he said for the first time since they've been running the survey, right?
Yeah.
That the US fell out of the top 20% of happiest countries in the world.
Yeah.
And among young people, I think it was like, they said the Gen Z generation, was it? I can't remember the exact
I don't remember, like it said like young people, and I don't even know what that means anymore.
Younger than whatever. Let's just say the young people in America, they've fallen to 62nd in the country, in the world.
In the world.
Which is pretty wild if you think about it. And so my take there was that I already mentioned it. I think the biggest issue, and we discussed like social media being a problem, but the biggest issue here is just expectations of what a good life is has never been higher. And so I wanted to bring some facts. And so another survey done, this was, I think, also in the Wall Street Journal a while back, but this comes from Ben Carlson. We've mentioned him on the show before. It's fantastic. But a survey done of Americans, Brits, and French were asked whether their country is better or worse today than it was 50 years ago. Nearly 1/3 of Brits said it's worse. 41 of Americans said that it is worse off today than 50 years ago. And half of the French participants said that it was worse. I guess initial thoughts on that, guys, when you hear that.
That's wild to me because I want to know who's saying that, like which age demographic, because I mean, I wasn't alive 50 years ago, you know, so how can you say that? So I don't know. I'm curious how that was measured and who was responding to this.
Rabih, you got thoughts?
Yeah. I think there's a sampling bias in this study. This is my 2 cents of it, because those 3 countries were allies in the Second World War, and those are the countries who won the Second World War II, right? Second World War II, the Second World War.
The second, yeah.
English at its finest.
I didn't catch that. I was like, yeah, you're so right. I believe anything Rabih says.
And 50 years ago, we're talking about in the 70s, they were still at the Cold War, and those developed economies were reaping the benefits of, you know, economic prosperity and just the accumulation of all the innovative technologies that were created during the wars. And does this effect start diminishing with time? Because we know that humans innovate most when they are in times of stress and when they are in hard times. Yes, it is. So there's still, right now, there's less residual effect from the advancements that World War created than there were 50 years ago. So if you ask a third world nation, third world country, is your life better now than it was 50 years ago? I think the answer would be the complete opposite. Because after the war, you got winner and loser, and now they are trying to they're equilibrating towards a middle ground between the standard of livings of the two. So yeah, I think the sample size is too small, and you're just asking one side.
And that very well could be the case. I think and I don't know this, right? Except for we're showing 2 data points, right? We're showing this data point and then that article that Will referenced. That either way, there's a large group of people today, let's say in America, that are saying that we're worse off today. We're worse off today in America than we were at some point in the past, right? And so, and again, we talked about last week, I want to bring some facts of where I think this is more around expectations than it is reality. But again, before I jump into these, Victoria, any other thoughts on that?
No, let's keep it rolling.
Okay, so there's one thing I will say. There's a fantastic book called Factfulness by Hans Rosling, the late Hans Rosling. This is like the whole premise of the book, right? His entire book is based around this idea that, again, the world's better off than what the narrative shows. And there was several things he pulls. I pulled 8 just to show it today. We're going to go over. There's so many, but I wanted to pull out a few that I think kind of bring this to light. So we'll just kind of go through these. Stop me if you want to call out a fact that doesn't, there's something wrong with it. But number 1, the real price of plane travel in the US has fallen by more than half since the late 19th. So it has never been cheaper, inflation adjusted, to travel across the world. And we were saying this, Victoria, right? This idea over the last 50 years ago, camping was vacation.
All right.
Now, I mean, I would venture a guess. You talk to 25-year-olds, they've probably been to more countries than their parents, right? I'm going to guess, right? Just traveling is so cheap.
It's a lot more accessible now.
For sure. Number 2, roughly half the adults in the world own a smartphone. Supercomputer that would have been equivalent to a NASA, like NASA technology 50 years ago that's sitting in your pocket. Number 3, in 1950, there were 3 cars for every 10 Americans. Now there are 9 for every 10 Americans. Number 4, 1950, the average home size was 900 square feet. Today, it's almost 3,000 square feet.
That one, I think, was one of the more surprising ones that you shared with me this week, because I think, I don't know, maybe I'm interrupting you and you have another one to share.
No, go ahead.
But I think, like, me being part of the millennial stage group, you hear a lot like, oh, housing's so unaffordable. And like, there's so many millennials and Gen Zers that are like, I'm never going to be able to buy a house and blah, blah, blah. And like, yes, housing prices have gotten way more expensive. Rent is so expensive. So I think that, like, I've heard that narrative a lot and I've like bought into it a lot. And then I guess I just didn't realize, that long ago it was 900 square feet was like the family home and people were happy with it. And I'm like, oh, that's my 1-bedroom apartment that I live in by myself. Oh, and I'm like, a whole family used to live in here. It's crazy. And so I didn't take that into account when I was kind of believing just that side or just that statistic.
Yeah, I think the car, the air travel, the home situation, all of these facts, I think, again, I feel like kind of point to that we diminish the progress we've made by the fact that, again, we're expecting more of what a good life is. And, and I think these things kind of point to that. So before we jump into the last few, Rabih, any thoughts on that at all? Rabih's like, nope. Okay. Number 5, the average American now retires around 62. As we've highlighted before, dentists are later than this, but the average American retires at 62. 100 years ago, the average American died at 51.
Jeez.
It's pretty wild. Number 6,
insane.
This was an interesting one. The time spent on doing laundry, fell from 11 and a half hours per week in 19 to 1.5 hours in 20. And I think, again, that just highlights like these things we don't even like really think about of like everyday life that has been made better by technology. Yep. And you don't think of like a washing machine, but like think about how much less we spend on things we didn't want to do, 60, 70, 80 years ago versus what we do today. But those are things you don't think about.
No. And I mean, it's just a washing machine, but think of like a dishwasher and a refrigerator and an oven and all these things that we just were born into having received, that gives us so much more time to be able to do other things like travel, which is more accessible, drive around in your car. And so that's so interesting to me because like, imagine if you had to go home from work and like wash all your dishes by hand and wash all your clothes by hand, like all the time, you like wouldn't have as much time to be able to do other things. That's crazy.
For sure. Rabih's got thoughts or he's just so bored of this conversation. Either way, I can't tell.
No, of course I'm not bored. The thought I'm getting, all these statistics you're talking about either are reducing your costs and making you richer or giving you more time that otherwise you wouldn't have had. Mm-hmm. This is what has changed. But maybe cost effectiveness and richness and more time are not really the recipes to be happy. And now I'm thinking like, are we going to make this a philosophical podcast? Because I'm ready to go there.
Whoa. Hang on. We got to throw in some Bob Marley and talk about this. That's such a good question, Rabih.
Talk about global affairs.
Rabih has me on a Bob Marley like trope right now. No, like does having more time necessarily equate to happiness?
Yeah. And being richer just because other stuff are becoming less expensive.
Or is it making you more miserable?
The answer to that is clearly no, because we've like, as we're highlighting and in that article. So let's take the U.S. specifically, right? The U.S. has never been wealthier as a nation, right? Ever. And someone might be yelling and screaming, what about like the wealth inequality? We're not going to get into that, but we will just look at over the last 4 or 5 years, the group of people in the U.S. that have gotten the richest over the last, again, 4 or 5 years has been the middle class, right? The bedrock of America has been like, we are kind of in a mini golden age of the middle class growing their wealth, their income, like real wages are up, all these things that we all want, right? But again, that article in Wall Street Journal, we've also never been less happy. So Rabih, to your question or to that would tell me, as we're getting philosophical here, there is no, I don't think that more time and more money necessarily leads to this level of this purposeful life or this happiness. To me, as we talked about last time, that principle's never changed. It's relationships, the quality of your relationships. And that to me is really what is waning and what is really that's the biggest issue right now with these surveys when people say they're not happy. I think because the quality of relationships is probably lower than it's ever been.
Yeah, and I'd agree with that because I feel like in another episode I talked about the like loneliness epidemic.
Yeah.
And so that would feed into that narrative. Like as loneliness is increasing, obviously that means our quality of relationships and maybe amount of relationships is decreasing. So yeah, that's nuts.
We got 2 more facts, but Rabih, you have any other thoughts on that? Okay. Last 2, the world. So the world, according to gross world product, same thing as we've talked about GDP, but this is the of the global scale. The world has gotten richer according to gross world product in 51 of the last 55 years as a world, right?
Wow.
And to back this up even more, this is the last one. The number of people living in extreme poverty has fallen by an average of 100 people per day for the last 25 years.
In the world or US?
In the world.
Oh, wow.
Yeah. So there's a ton more. This article I pulled this from, there was 50 facts that prove the world is getting better. But
Yeah.
I just pulled 8 for this discussion. So again, I guess the last thing I'll say on this, obviously us being a dental specific podcast, we are not, sometimes we can, again, I don't want us to come off like out of touch, but I also want us to make sure that we're being reasonable and rational and bringing the facts and showing and trying to show that the actual data here. But if we're talking dental specific, because dentists out there may be thinking, well, if you look at the dental landscape specifically, you could argue that in some cases, depending on what you're looking at, it is worse off than it was even 10 years ago, 15 years ago, 20 years ago. And I think there are some cases for sure you could argue that that is the case. That for example, in dentistry, incomes have not grown probably at the same level as the cost of the education itself. With that said, people ask us this all the time. Is dentistry still a viable career? Yes, it definitely is. So anyway, I'll give you guys the last word on this. Any other thoughts on this before we finish up with Victoria's topic? Rabih?
I got something. I need 30
Yes,
seconds.
you
I
do.
need to read it to you.
Please
I
do.
was taking a course, economics course, a non-traditional economics course.
That doesn't
Let's
sound
put
like
it that way.
Weird.
A couple years ago. And the professor left us with this message at the end. I'm just going to read it to you and you guys can think of it. So here it goes. Imagine you live in a community or country where clean water is a resource available to the entire population. This is exactly like the air we breathe. Neither clean water nor clean air enters the price system. Therefore, it's not computed by the GDP. Let's say the water becomes polluted, then what happens? You will need to work a little bit more because now water is a private good that is cleaned, bottled, and distributed to the grocery store. What is the impact on GDP? Well, now the GDP will grow. People get poorer and life quality has worsened, but the GDP is greater the water was a free good. If you live near your work or study place, a privilege in our society, this is just like the air we breathe. It does not count and it does not exist. This is a zero from the GDP's calculations perspective. However, you need a car or public transportation if you live far from that place. Therefore, you will get stuck in traffic, burn fossil fuel, get anxious, angry, mad. This also increases the GDP. The mental disease we develop from this situation will be treated with a counseling and a doctor, which increases the GDP. When we start to use bottled oxygen in our pockets to survive, this market will also increase the GDP. So when we study these stuff and we think critically about them, maybe GDP is not really how we measure happiness.
Yep. Love that. Oh my gosh. Okay, wait. Speaking of that, I had to pull this up because I was thinking there was a quote from JFK about GDP. I wrote an article about this a long time ago, this very thing. So this is from Bobby Kennedy on GDP, and it sums up what you just said. GDP measures everything except that which is worthwhile. Like what you just said. So yeah. I'm with you, Rabih. Love that. Okay, Victoria, any final thoughts? We're going to jump to yours.
No,
we're
do we have
longer.
time for mine?
Yes, we do. We're getting philosophical here. Hopefully this is still
this
helpful.
Was like a
I love this.
Breath after this.
I love this.
Cool.
I'm going to go journal, as Ryan always says. Okay, last one, and we are calling ourselves out for the same thing the media does. We changed the word on this. Does having a brush with death increase your likelihood of saving for retirement? The word we were going to use, we battled this before we went on, was mortality. And we were like, no, death sounds better.
Which I will say, just for the record, I thought of mortality. And then Matt was like, should we make this more dramatic?
Like, death.
And it was Matt and Rabih that were like, let's use the word death.
Death. So we wanted to get the people's attention. Study buddy. Of course, you gathered all this stuff for a study, from a study.
Yeah.
Tell us what the study tells us.
Yeah, definitely. Well, I'm kind of bringing back the topic of retirement because something that I personally find really fascinating is like why it is so difficult for people to save for retirement. Because, for some people it's really easy and they're like, okay, yeah, I know I have to do this. And I feel like for me, it's kind of just like a checkbox item. So I like to kind of understand more so why it's so hard for like people in general or people who like experience that. Like, anyways, so what I found was it's actually just really, really difficult for humans to think far out in the future. We're not wired to do that, like literally at all, because we're a fight or flight survival species, and thinking about yourself in 30 years is really, really hard. And so that's a lot of what drives difficulty to save for retirement, because I can't picture myself an older face and like what I would look like in 30 years. So what
you can now with AI. You can now.
I know, but I won't do it because I think I'll have a panic attack.
Yeah.
So I won't. But again, I have to bring all the studies because it's just a deeply rooted imposter syndrome. So here we go. And so this study showed that from MRI studies, it suggests that when you imagine your future self, your brain does something weird. It stops acting as if you're actually thinking about yourself. It actually starts acting as if you're thinking about an entirely different person. And so for a lot of people in their subconscious, it literally feels like you're giving somebody else your money and it's not for you. And so that can make that money habit really difficult to build over time because it doesn't even feel like it's going to you. And so the other thing that I'll throw out there too is the further out the time period, the harder it is to imagine. So some stats to throw in here. 53% of Americans say they rarely or never think about the far future, something that'll be 30 years away. That decreases to 36 when it's 10 years, and then decreases even more to 27% when it's 5 years out. So we're okay kind of thinking about the next few years. We're really, really bad about thinking about the future. So tying back to why people should care or like take away from this is, yeah, it makes sense. If it's difficult for you to invest or kind of get started or feel motivated to do that, it's because your brain's not wired to. So I don't blame you. But that doesn't mean that you shouldn't be investing for the future because that is coming.
Yeah, I know just from my own life that totally makes sense. It's really hard for me to imagine myself 30 years from now. Like you said, It feels like a totally different person. It absolutely does.
Yeah.
We were
like
joking.
I'm going to live forever. I'm young and
yeah, exactly. We were joking about like I being able to see see you as an old person, but I've actually, and I don't know this stuff, I'm just pulling this out of something I read some other time, but I believe there actually was studies done around people who they did a study where people through AI, like they were able to show themselves
what they would
20, 30 years, what they would look like down the road. And it actually made them better savers.
Wasn't that from Thinking Fast and Slow?
Probably.
I feel like it was in that book.
Kahneman or something. Yeah.
Yeah. I want to say I read it there. But yeah, if you see yourself, and there's studies on this too, where if you take some time to actually like picture what a day in retirement looks like for you and you like very, very visual with it, you're basically tricking your brain into thinking it's happening right now. And if the more you can trick your brain into thinking it's happening closer to where you are, the more likely you're going to save for that future you.
Yeah.
So
also thinking of the Jerry Seinfeld bit of tomorrow guy or the morning guy versus night guy. Anyway, he talks about this very thing in this moment of like, you're going out late at night, going to a club or whatever, and you're not thinking about morning guys. Like, that's morning guy's problem. It's kind of the same thing. It's like, that's retirement guy's problem. Like, it's a totally different person. And I think it kind of, again, it's in a joke, but it kind of speaks to this very thing. I'm curious where the death, is there anything like having the brush with death has to do with this?
I was gonna wrap up with that.
Oh, okay, sorry. Before we do that then, Rabih, any thoughts on this before Victoria wraps up with the death part? With death.
I just want death. Let's go to the death.
Hit us with the death.
Okay, let's do it. Okay, so where did I just put this? Okay, so in the same study, the data showed that having children or grandchildren actually did not increase future thinking. However, one life event did. A brush with mortality, such as a potentially terminal medical diagnosis, a near-death experience, or traumatic event. So if you have a near-death experience, you're actually more likely to save for retirement. So I guess with that thinking, should we all have a near-death experience so that we're more likely to save for retirement?
That's actually interesting. I would not. That seems counterintuitive to me.
Why do you feel that way?
I feel like that would be more, I think it would put
you into YOLO mode.
Yeah. I feel like it'd be more like live for the moment. I don't know, Rabih, how do you feel about that? What is your intuition?
I see where you're going, but I think that the event of like brushing with death is going to be depending. It's like, is it deterministic? Like you got diagnosed with like an illness, and you know when the timer is going to set off. Like you have 3 years, 5 years.
Yeah.
This is different than living, and this is me reflecting on my life in Lebanon, living in an area where sometimes you're going to be so close to death and sometimes you're not. It's probabilistic. One day an explosion might happen. Let's not go into the details, but this is like my personal experience. Like one day something bad might happen, and the other day you might just be living. And when you adopt the latter scenario, which I lived with, you're like, you never take the current moment of peace for granted. And you're always, it's like you're in a constant state of worrying that you should be self-sustaining when stuff are not going the right direction. So I guess it's gonna depend on how deterministic the brush with death is. It's like, yes, it is determined. This is all the time you still have left, then your behavior would be something. But then if it's the situation where, oh no, the world is just riskier and more dangerous than you expect, then you would adapt a more of a saver's approach.
Yeah, that's a good point. I also think about this idea. I guess when I'm thinking of this, there's two different parts, right? There's the you having the brush with death, right? This traumatic event, whatever it is, and then you losing someone, like you having that quote unquote brush with death with someone close to you. I guess maybe I'm thinking more of that, is that when you have someone close to you that dies, what you feel is way too soon. I have felt in my personal experience, it's shifted my mindset to be more of this, not YOLO, but more of this like embrace every day, live more in the moment. And I'm more projecting because of my own, like my situation where I have had the mindset of retirement. Like I've always kind of been driven by like, oh, the savings is growing, thinking about retirement, all that nerd financial planner here. And then you have a situation where you have that brush with death or someone close to you dies, and then it like shifts you back more to the present moment. So I just think there's a lot to this. Maybe that's why I'm thinking, or my intuition would be like, I think it would be the opposite.
Yeah. Or I don't know, maybe the near-death experience was such a financial burden on you at the time, or a traumatic event. It like really weighed on the finances, so you want to make sure that never happens again.
Yeah,
type of thing.
Could be.
I can see that perspective.
But the data is the data, study buddy. So
the data is the data. Sorry, don't shoot the messenger. Yeah. I guess
no, I think it's great. Yeah, what's the takeaway here?
I think the takeaway, or I don't know, like something that like helps me is like yeah, future 30-year-old Victoria, like it does feel like somebody else entirely, but I am trying to almost like develop a closer relationship with her in a way. Like, sure, yeah, you can view that as an entirely different person, right? There's nothing wrong with that, but then like kind of have some reason to feel like close to that future person, maybe like an imaginary friend. Maybe I'm just crazy, but what I do,
maybe
like,
I just have an imaginary friend named
maybe
Debbie.
I just have an imaginary friend named Deborah, who's me in 30 years. But I don't know, something that like I try to practice regularly is doing something for my future self. Like, oh, I'm gonna put the dishes away, this is for future Victoria. Or I'll be like, oh, thanks, past Victoria, like that was cool of you to do, like you were thinking of me, like getting gas like the night before so future Victoria doesn't have to on her way into work, type of thing. So I think trying to almost like bridge that like future self and also feel connected to your past self can just make you feel in a way more tied to that and more motivated to want to save for that future you.
Yeah, I think that's good. Getting in the right mindset. The last thing I'll say on this too is the whole time sitting here thinking the importance of having a system, like removing thought from the process where you don't even have to be thinking about your future self. You're just like, I set up the system. I'm not even thinking about it.
Yeah.
And you know, don't limit the amount of times you're checking your portfolio, like things like that, where you're removing that even from your mind as much as you possibly can, I think is critical there as well.
Yeah, I agree.
Rabih, final thoughts?
My takeaway from this deep podcast, we
did get deep, guys.
We did get deep.
Are we okay?
No.
Fine. I think my takeaway is that we think money and all of our financial like approaches to life as something completely separate. And it's like, oh, there's a one size fits all. You have to save, you have to invest, etc., etc. Where in reality, money is just a tool, and it's a reflection and an extension of our own existential behaviors and worries. Like when it comes to what makes you happy, well, you have to go deep within yourself, introspect. Because if you're going to be spending your money later on, you're going to have to do it in a way that maximizes your happiness and not drift in this trend that the US is going through where people are becoming less happy. And if you are going to be saving, well, you also have to go and introspect and worry about what you think the landscape out there is, what is still of life that we haven't experienced, and how risky it is, and how much of that will require me to invest and save in my future. And it's really a balance of our own outlook on how life is is, and it's translated into our money decisions.
Wow.
We're going to leave it there.
Okay. All right.
Guys,
That's it. That's all, folks.
we got deep today. We got
really
deep today.
did.
I had loved it. I mean, Rabih and I, Rabih, you and I have had so many philosophical discussions like this. Victoria, you and I as well.
Yeah.
So we're just doing it on the air today. I loved it. And it actually leads perfectly into our call to action here, which is, if you want more of this stuff, this is kind of the theme. This is the theme of our summit coming up in June. We're about 90 days out. This literally is it. Like, we're talking this very thing, Rabih, how you just wrap that up, is trying to find a way to align your money with your values, live a meaningful life. It's not just about the dollars and cents. We have so many incredible speakers coming to talk about this exact thing. So definitely check it out. Dentist Money Summit, June 21st and 22nd in Park City, Utah. It's going to be incredible. More conversations like this, not only from us. Come meet us. Come talk to us about this. Tell us why we're wrong, maybe, or why you think we're right. Either way, come hang out with us. Come listen to speakers in Park City. It's going to be amazing. Sorry we went a little long today, but hopefully it was helpful. Very philosophical, guys. As always, that's our 2 cents. Only one thing left to do. Go forth. Live your rich life. Bye-bye.